Here's your housing update. It's May 23rd. Let's jump in and take a look at some numbers, look at some graphs. As you can see, we really don't have a whole lot of different data to report. The housing market seems to be picking up in terms of pendings, but when we're looking at solds and for sale, it's just kind of flatlined. We go in and look at average price per square foot, and despite the 500 basis points or 5% increase in interest rates, we see that housing prices, they're actually going up per square foot. We see this across the board. Months of inventory, we see it ticking up a little bit, but it's less than 2 months. There really isn't any inventory available. There's a number of reasons why, but today I wanted to share this article I ran across. And this is from the Wolf of Wall Street. I'll put a link in the description. The Fed's interest rates are still fueling inflation rather than dousing it. Well, what does that mean? The graphs here are pretty telling. Here we look at consumer price inflation. So these are core goods that we use every day. And you can see the CPI number is outpacing the interest rates. So they're raising interest rates, but are they being aggressive enough to be able to get the inflation to come down? Because what this means is we're still consuming. Even though we've had 500 basis point increase in the federal funds rate, we're still out there consuming. The reason why is because the goods that we are consuming are goods that we use every day. We can't not consume fuel. We can't not consume groceries. We have to have clothing. Stuff like this is what really is fueling inflation, even though they say it's not included in that number under the pure definition, but it is. This is another chart, and we're looking at CPI versus federal funds rate, and we're going back to 1965, and you'll see in 2008, the federal funds rate was inverted. Typically, it was 2 times, federal funds rate was 2 times what the CPI was. And now we've flipped that on its head since 2008. How are we ever going to control inflation if we're not willing to get aggressive enough with interest rates? In my opinion, I think interest rates should be 10% right now if we're really going to try and keep inflation in check. But at 10%, it would kill the entire economy. We're going into an election year. Historically, the United States has never had a down market in an election year. I don't think they're going to start this year. Those are my thoughts on today's market update. Will they ever do enough to keep inflation in check? I don't think they will. I don't think they can afford to. And then we also have the debt ceiling that's looming. If the U.S. defaults on their debt, what's going to happen to the full faith and confidence of the U.S. taxpayer? Well, we're reaching a point right now where we just simply can't afford to pay the debt. If you and I spent money like the federal government and maxed out our credit cards like they've done, where would we go for more money? We can't just keep printing money ourselves and in our household, but our federal government seems to think they can. Very strange market that we're in. We'll see what happens with the debt ceiling. I think they're going to find a solution and increase it, but that's not a solution to the problem. You're just kicking the can down the road. The question I have for everybody watching this video: how in the world is our federal government ever going to repay $34 trillion in debt? What's the plan for that? So anyway, I hope you like this content. Share it, give me a thumbs up, follow me, and I'll catch you on the next video. Thanks.